Bitcoin is a risk-on asset and a risk-off asset. That's crazy. We don't have too many of those. So pretty interesting. You can see during recession, so 2000 to 2002, velocity drops at an accelerated rate. You saw that again in 08, 09, and you really saw it during COVID. And what's happening now is we're just moving back to trend. And I think trend is at about 1.4, so we have a little bit more to go. But if we do enter a recession, and as you know, we think we've been in a rolling recession for roughly 2 years now, starting with back-to-back declines in real GDP in the first half of 2022. And of course, we've seen housing measures drop by up to 40%. Autos are in recessionary territory. We're seeing non-residential construction, especially in the office space area, in desperate straits, offset somewhat by IRA spending, the Inflation Reduction Act spending, which is focused more on infrastructure. But nonetheless, rolling recessions, and we think the next sector to pull back probably is the consumer. We're already hearing from retailers that the discounting is picking up in order to attract consumers into good deals. And we're hearing words like deflation used by a company like Walmart, very interestingly. So we'll get back to trend. And then, of course, the risk in a consumer downturn is that this velocity measure continues down, that it resumes its downtrend. And what would that mean? It would mean we'd have money negative on a year-over-year basis, and we'll have velocity starting to roll over. So that's how you get a really hard landing, unless the Fed pivots and money supply picks up dramatically. So in an election year, now the Fed is independent, but the Fed tends to stay out of politics and not make moves to favor one party or the other. But we do think it's going to be forced to ease and by economic statistics that will make it overwhelmingly clear. And that's a word that Larry Summers used today. He advised the Fed not to change policy, not to cut interest rates until there was overwhelming evidence that the economy is weakening and inflation was coming below the 2% territory. We think there will be overwhelming evidence, and that will happen next year.
In a recent report, Matrixport, a crypto investment company based in Singapore, says that U.S. inflation should be given a lot of attention because it is a key factor in how much Bitcoin wealth people accumulate. Inflation in the U.S. has gone down from 8 a year ago to 3.1 now, and experts think it will go down even more to 2024. Analysts think the difference between Fed funds rates and the consumer price index will likely stay the same, even though the Federal Reserve says that interest rates will go down in 2024. This will cause Bitcoin wealth to grow even more. Analysts also say that crypto buyers shouldn't expect another rally in 2023, since Bitcoin has only gone up a few percent points in the past, from December 24 to December 31. This is because the market was expecting less activity over the Christmas holidays. Matrixport also thinks that the spending rate will go down. Even so, there may still be a lot of volatility as traders try to protect their accounts before a Bitcoin spot exchange traded fund is approved. As Crypto.news revealed earlier, key 33 research analysts think that the U.S. Securities and Exchange Commission will likely approve spot Bitcoin ETF in the next 3 weeks. This is because issuers like BlackRock have been filing a lot of updated zones. Let me now talk about another measure I want to share. We did the same thing last month, but I forgot to add something. This is the yield curve. What is the difference between the return on a 10-year bond and a 2-year bond? And when there is a recession, which is shown by the darkened areas, the yield curve either goes down right before the recession or in the middle of it. As you can see, it's mostly a moving average. In the 1980s, late 1980s, and all the way through the slump of 1990, it turned over again. Means that we're turned around. Went back below zero before the tech and telecom bust of 2000. The same thing happened in 2008 and 2009. We're back here again. You can see that the yield curve has swung around more than it did during any other decline since the 1980s. Last but not least, I'd like to draw your attention to the yield curve during a slump. When the Federal Reserve is stimulating the economy and the government is also stimulating the economy, these days, it's around 2-3. What does it mean? This usually means that the yield on a 10-year treasury is 2 and 3 higher than the yield on a 2-year treasury. You'll also notice that didn't happen during COVID. That's interesting. It's also strange because the world tried a lot of different types of monetary and fiscal strategy to help with COVID, and you might have thought we would at least get back to the range of 2 to 3 percentage points. We didn't. Why now? If we are right, it's because the bond market can smell a world where prices are falling. Along with 2-year treasury rates, long-term yields just didn't go as high as many people thought they would. That's because they're looking at these signs of decline. Long-term treasury yields would stay low if inflation or deflation went down. When we looked at this during the day, I thought, wow, I didn't realize that all that stimulus couldn't get this yield curve back to the normal range of 2 to 3. The last 3 times it was more upside down than this time. We have to go back to the early 1980s. That just proves that monetary policy is much stricter than most people think it is at the moment. Plus, the most recent set of numbers from October showed lower than predicted inflation and activity. This has made people expect the Fed funds rate to go down.